When the major banks reported last week, they knocked the ball out of the park. But they're not the only financials that are winning here. Many of the regional banks have caught fire, too. Take one of my favorites, First Horizon National. That's a Tennessee-based regional bank with more than 350 locations across the Southeast. When First Horizon, FHN, reported last Tuesday, the company delivered a 5-cent earnings beat off a 37-cent basis. That's a giant beat for a bank. Higher than expected sales, up 6% year over year, driven by higher fee income. When you drill down, they had 5% average loan growth. That's very strong. Their efficiency ratio off the charts. The percent of sales that they spend on non-interest expenses down big, coming in at 59%. Wall Street was looking for 62. Oh, there's a lot to like here. No wonder the stock jumped 6% on the news. This is a bank stock. Now, Wall Street's been nervous about the banks because the Fed looks set to cut short-term interest rates, and that should cut into First Horizon's profitability. But at this kind of quarter, you got to wonder whether the stock might be worth owning in spite of the Fed. Do not take it from me. Let's check in with Bryan Jordan, the always reliable chairman and CEO of First Horizon National. You had a better sense of the quarter, where the company's headed. Okay, I got to tell you, Bryan, this was a quarter that made me think, you know what, let's forget about net interest margin. Let's talk about growth. You've got maybe the best growth of any bank I follow in this country.
Well, thank you. We have an outstanding footprint, and the economy is still very, very strong in our footprint. And if we're slowing down, it appears to be that it may be more regional on average. We're seeing very good growth in the Carolinas and Tennessee and Florida.
Now, it also seems that this is the kind of ideal time for a bank. Your charge-offs are low. You've got something, your specialty lending is on fire. It just seems like this is the environment that we've been waiting for, which is why your stock has taken off.
Yeah, I agree. Credit quality continues to be very, very good. And an interesting statistic, annual financial statements come in and they get reviewed about mostly from the end of the first quarter through the end of the second quarter. This year we had fewer credit downgrades, which is a degradation in credit with our borrowers, than we've had in any of the last couple of years. So credit quality continues to be strong. Interest rates are stable, as you suggested in your intro. We'll probably see the Fed cut this month and maybe again later in the year. But the economy, as I said earlier, is still pretty strong. Borrowers are borrowing money, and we're still very optimistic about our ability to grow in this environment.
You know, Bryan, the negativists are going to say, well, wait a second. You two guys are talking. You're really excited. Well, what the hell does the Fed need to cut rates for if things are so good? I mean, I could argue that you could even get that things could get better because there's no inflation from what I see. Why not cut rates? I mean, what is the point of that last quarter point? Do you agree?
Yeah, I think that's the basic argument with inflation running plus or minus 1.5%, 1.6%. If the Fed cuts by 25 basis points and inflation goes up a little bit and it strengthens the economy, is that a bad thing? And I think it'd be hard to argue against that. And I think that may be the fundamental underpinning of what drives a decision in the next several quarters.
Now, is there an anomaly? Is it possible that Tennessee, North Carolina, South Carolina, and Florida are the strongest states in the country?
Well, I don't know if they're the strongest, but they're going to be some of the strongest. Is in my view, they're great environment for business. They're good for labor. They're good for cost of living, low tax states. And so we're seeing a lot of opportunity. And as we talk to borrowers across the entire franchise, while there's a little bit of concern about what we don't know that's being factored into the yield curve and what may be happening with tariffs, on the whole, people are very, very excited and optimistic, and their balance sheets are strong.
Do you think that we can possibly say that there's two economies? There's the consumer, who's doing incredibly well, and then some of the larger companies that have to deal with tariffs and overseas that aren't doing as well or are concerned, because it does seem like Washington is making life troublesome for some of the companies that sell overseas.
I think that's fair. The consumer is still very, very strong, and you see that in credit card usage. You see that in consumer confidence. You see that in employment reports. And you never can lose sight of the fact that 70% or so of the economy is driven by the consumer. There are some things that are impacting commercial entities, and those are real, and they're likely to have some impact. But if people can stay employed and they continue to spend money, I think the economy will be stable. And whether we come in at 1.5% or 2% growth later in the week on GDP, I think we're in a period where, with lower interest rates and strong consumer, we can see a pretty attractive economy for the next several quarters, if not years.
Now, how were you able to, for a long time you had the Bonefish plan, it was really pretty amazing, but it just seems like this one quarter, the expenses really clicked. It showed me what could happen. You have expenses doing nothing and revenues going up. That makes you a very valuable franchise.
Well, thank you. We still use the Bonefish. It still drives our financial management, and we're very focused on driving return on equity. We use the phrase often, we try to control what we can control. And as we completed the merger integration with Capital Bank and we completed the $85 million in cost saves, we saw additional cost opportunities that we think we could realize. We took some of those and took them to the bottom line, as you said, by keeping costs flat to down. And at the same time, we're continuing to make investments in the business. We're hiring bankers. We're bringing people onto the platform. We're investing in technology. So we're trying to focus on eliminating the bad costs and keep spending the dollars on the things that will help the business grow.
Well, I got to congratulate you. It was just the breakout quarter that I knew could happen. You just did a great job. That's Bryan Jordan. He is the chairman and CEO of First Horizon. Hey, guys, you want these $16 stocks that you should get excited about? Get excited about this one. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.